There is a ton of debate in the life insurance space about how to properly design a whole life insurance contract. Now, in this video, I'm going to cover the 1090 design, the 4060 design, and ultimately, I'm going to show you why both of those policy designs lose to my favorite design that I'm going to show you at the end. You got to stay till the end to make sure you learn this, but also make sure you don't skip ahead, because if you skip ahead and you cheat, you're not going to understand exactly why it's so important. So make sure you watch this video into fruition, to its fullness, because when you do, I promise you're going to come out of this video learning a ton about the business, whether you're looking to sell this and learn how to do it for yourself, or whether you are somebody looking to possibly do this in your own life and implement this strategy in your own life, and you're just kind of bouncing around and figuring out what are the ways that I want to design a policy for me and my personal finances, whether you're a real estate investor, a business person, you're looking to just have an emergency fund for your family, an opportunity fund, you're just looking to get some safe money to weather the recession that we're coming into, you're going to want to watch this video. So if you haven't already, please subscribe and hit the bell, that way you're notified. And if you find value in this video, share it out, because the algorithm loves that and it will help the channel a ton. If you find value in this video, I'm sure other people you know would also find value. And so I'm just grateful for everything that you do to be able to help me grow this channel. And that's it. I'll see you in there. Make sure you stay to the end. You won't regret it. Hey, what's going on, cash flow hackers? It's Chris with Life 180. And today, as I just told you on the hook, we are talking about whole life insurance. And you can't see it. This is a little blown out, but I have my monitor here. I don't know why it's blown out with the lighting right now. I can't get the camera to work properly, but I promise you it's gonna come through just fine. I've got a monitor. I'm gonna share my screen in just a minute, but here's the deal. When I'm talking about the different designs of whole life insurance, and there's a lot of debate, there's a lot of people that debate 1090, 4060, and that is probably the most common debate. The infinite banking purists will tell you that a 4060 design is the best way to go, and that's just what Nelson Nash did. And a lot of companies, honestly, when Nelson Nash first started, didn't even really offer 1090 designs. And there's a lot of people, certain channels that will tell you 1090 policies are the only way to go. In this video, what I'm doing is I'm basically breaking down a specific sample. I took a 35-year-old, took a 15-year term rider that we added with a level term rider to be able to dump more money into PUAs, and I'll explain it all. But I did a 1090, a 4060, and then I did my favorite, and I want to get into it right now. Let's just share this, and we will go from there. So check it out. So you can see right here, I've got the 1090 policy is what we have. Now, on here, it's important to see we have guaranteed and we have non-guaranteed. Now, the non-guaranteed is based on the fact that it's going to be paid at the current dividend scale. Sorry, I gotta update that. So it's going to be all the cash value. The net cash value is going to be paid at the current dividend scale. The increase in net cash value is banking on that as well. Now, you can see the premium, $10,137, and you can see here $8,953 is liquid year one. So this is a classic 1090 policy. So what does a 1090 policy mean? A 1090 policy means out of this $10,137, so basically 10% goes into base and 90% goes into PUAs. Okay? So paid up additions. If you don't know what PUAs are, they're paid up. PUA equals paid up additional permanent insurance. Okay? That's what paid up additions are. PUAs are paid up additional insurance. And so basically what they're doing is they're buying little chunks. So you notice here that the death benefit is smaller and it gets bigger and bigger. That's happening because the paid up additions are getting added onto here. So with that 90% of the policy going into paid up additions, it's buying little chunks of more insurance that are going to make the cash value grow, and it's also going to increase the death benefit. This is how you can increase the cash value and get more insurance. Kind of have like, it's not the same, but kind of in increasing death benefit that is like kind of similar to how it would be in an IUL. but it's an increasing death benefit only because, and it's better because it's all paid up. It's guaranteed once the money goes into those, into the paid up additions. And so here's the deal. You see 10,137 is the premium, and you could see $8,953. Now, this is what I was going to do before here. Let me see here. I want to get the calculator, and I want to see what the liquidity of this is. 89.53, 10,137. So that's 88.3% liquidity, okay? So 88.3% liquid year one. But here's some things to look at, to consider. You got 10,137 going in year two, but when you look at the net increase in cash value, it goes up by $9,762. So you're still a little down. Year three, the policy's finally going up by more than you're contributing to it. And then by year, well, basically year five, you're break even because you're 50,685, 50,879. So you're a couple $100 behind, but for all intents and purposes, you're broken even. Year six, you're actually ahead. You can see the death benefit is going bigger and bigger and bigger. But this is a pretty good policy. Now, here's where this policy gets a little less attractive. And this is where the downfall to a 1090 policy with a level term rider is in existence. And so you can see here that at year 15, the term rider ends. Now, what happens here, that because we've been buying paid up additions, the term rider is going to drop off, but the death benefit you can see falls right there from 504 to 405. But here's the deal. That dropped because the term rider dropped off, which was made up for in the extra paid up additions at that point in time. But here's the problem. Because of the fact that we are not able to have the term rider anymore, for full transparency, I could take this and I could extend the term rider to 20 years. I could extend it to 30 years if I wanted to. I could do that. It would allow me to extend this 137 all the way down. So as it stands right now, just know with the 15-year term rider, if I were to go with a 30-year term rider, that's going to it's going to mean there's more expenses that go along with the policy. So the longer term rider, it's going to be more expensive for the term rider, so it's going to have a negative impact on the cash value a little bit. And so just know that that variable exists. Typically, people are asking about a 15-year window, and they kind of go from there. But you could see at year 16, they're able to fund it, not quite to the full extent, but year 17, 18, 19, 20, they can only pay $11.37 per year. Why is that? Because that is what the base is. So here's the deal. The base of the policy is what is absolutely contractually obligated by the life insurance company to meet, right? The rest of it is there because of MEC laws and all this stuff, but that doesn't, the base is the only thing that from the long-term perspective of the contract that the insurance company is going to guarantee that you have in the policy from being able to fund it to that level, right? And so when we look at this and we look at a 40/60 policy, let's take a look. Now you could see here we got the 40/60 policy design. All the same principles reign true. When I ran this, had this run, for some reason it showed 10,000 flat. The other one was 10,137. It's pretty close. We'll still talk about the same principles and the same ratios and whatnot, but you can see here with a 40/60 policy, you only have 67,000 in net cash value. And you can see here, whereas on the 1090 policy, we had year 3 is where the increase in net cash value was greater than what we're contributing in premium. And you can see here, it's not till year 5 that the increase in net cash value is higher than the premium. That's a big indicator that I look for. But here's where it gets interesting. So year 10, we got $104,000 of cash value in the 40/60 policy. And in year 10, in the 1090 policy, we're ahead. We got about 115. So that's not, not a small number, right? Now, what I would also look to is in year 20, we have $257,000 of cash value. And in year 30, we have 401,000. Now, here's the deal. We haven't been able to fund this policy properly because when the term rider falls off, it's going to shorten and shrink our ability to have a bunch of money go into here. Now, I know we always say we're not looking for death benefit, but at the end of the day, it is life insurance. And if we can have our dollars perform more than one function, the tax benefits of the death benefit are huge. So well, let's just keep it all going on year 30 here. So $587,000 death benefit with $401,000 of cash value at year 30. So now what happens is let's go to this policy. And so remember, 104, we're behind. But now at year 20, at year 20, we are now ahead. Wow. It's dragging it for some reason. We are now ahead with the 40/60 policy. And why is that? Because of the policy, we were able to put a little more money in, and it was going to be pretty close even if we had to reduce the premium. It is what it is. But now look at this. At year 30, when we compare the two, we go from 401 all the way up to 467 and $694,000 of death benefit instead of 587. So that's a significant difference, right? That when you compare those two differences, it's important when we look at this apples to apples. Remember, these policies are identical except for the blends. I've got the same term rider attached to it. It's design minimum death benefit, maximum cash value based on the blends that we're doing. So it's the term rider. You notice with the 1090 policy, you start off with a little less. Why do you do that, actually? That's actually surprising to me that you start with less, because I would figure with a bigger term insurance rider, you would have more insurance, but that's actually not the way it worked out, which is actually kind of interesting to me. So we look at those two things, and that is what it is. Now, if you want to look and see, okay, what is right for you, you just have to figure out what are your long-term objectives. The longer you want to fund it, I think going with a higher base is good as long as you are able to deal with the short-term liquidity difference, which, by the way, isn't that much of a difference. When you look at your 544,000 compared to 55, that's about 10% difference in cash value liquidity at that time. But you're talking about the long term. If you're looking at year 16 and beyond, when you're talking about when the term rider falls off, that's when this policy actually starts to perform better, right? That's when the 40/60 will perform better. During the term rider, the 1090 policy is going to perform better, so you just need to know that. Now that we got those two things out of the way, and that's important to understand, I would say if you have any questions about this on the designs, on the 40/60 differences to the 1090s, comment in the comment section below. But now let's go to my favorite one, and this is called a front-loaded policy. Now you can see here that we have the same $10,000 per year premium. The difference is I took $100,000. Imagine if you had $100,000 sitting in a savings account, sitting in a CD, sitting somewhere in safe money that you wanted to be able to keep liquid and have access to it, leverage it for real estate, your business reserves, your emergency fund, whatever, but you wanted that money to do multiple functions for you. Well, now we're able to take this $10,000 premium, as you can see here, but we're also able to get that extra $100,000 to work right away. Now check this out. The net cash value liquid year one, $101,000. So I don't even need, well, I'm going to do the math and get the exact numbers, but let's see here. 101,803 divided by. So it's 92.5% liquidity, okay? 92.5% liquid as far as that goes. Now, it's not completely liquid. That's the net cash value. You're not gonna have access to the full liquidity unless you go get a certain cash value line of credit with certain banks. The only challenge with that right now is that lines of credit rates have gone up with the markets, whereas the interest rates with life insurance companies in these mutual companies have stayed lower. And I'm gonna actually do another video explaining how what a benefit that can be in the years to come. So having access to this gives you flexibility on the lending side. But just know, you got 92.5% net cash value in the policy, of which probably 95% you could have access to if you needed it. Now, here's the cool part. Remember, year 2, look at this. The net increase in cash value, you put in 10,000, it grows by 10,953. So that first offset year is year 2, where you're losing a little bit of liquidity, 7.5% of liquidity, so to speak, and the policy is actually going to grow by more than you contribute starting year 2. Now, in this industry, that is quite the feat to be able to pull that off. You could see it's year 5 here, and it's year 3 there. But this is actually year 5 before it actually grows by as much as this policy grows on a percentage basis in year 2, right? So this is far and away the more efficient contract. Now, here's the deal. When I look at this and I go, okay, I got a $10,000 a year premium, I'm dumping the policy in, look what it's able to do for me. Because I did the front load, because of the way that we were able to design this policy, we had higher liquidity, we have more death benefit. Look at the death benefit excess compared to the other ones. So imagine you could have a higher percentage of your liquidity. The cash efficiency starting year 2 is going to be better than the other 2 policies, and you have the death benefit. Now, I know I'm showing that the death benefits, it's going to be bigger. And when the term rider expires, check this out. Yes, the term rider drops off, and so you can see, you have $709,000. So it's like almost $1.4 million of term insurance that dropped off there. That term insurance, that 1.4 term insurance, is what was needed to get this $100,000 inserted into the policy, right? And so when you look at this, this is the cool part, right? When you look at this, now, not only did you get all those other benefits of the 1090 liquidity effectively, but you were able to keep funding it at a much higher level, which is pretty powerful because that's going to allow it to grow. So now you get down to year 30 and you have 771,000 instead of 401,000, and instead of $587,000 of death benefit, you have $1.146 million of death benefit. And so when I think about this, when I think about what is the optimal design of a policy, I'm always thinking about how much money do you have to front load the policy. And if you could figure out how much you have to front load the policy, that is going to have a big indicator on how much I guess if you reverse engineer, you front load the policy, you reverse engineer what you need to pay every single month, or you can look at it the other way around and you could say, and honestly, I guess I kind of said that a little backwards. The way that I would do this is I would focus on knowing how much you can afford per year. So if $10,000 per year is your number, then it should go up and you could say, hey, all right, then I know I can jam in $100,000 on top. And out of that $100,000, the great part about that is, you know that that $100,000 extra you're going to put in is pretty much going to be liquid compared to what you would do in another scenario. And it gets you the best of both worlds. You get more life insurance, you get higher percentage of cash value, you get better growth, more efficiency early in the policy, more efficiency later in the policy. And this right here is exactly what you need to do. This one right here is exactly what you need to do if you want to have the best asset, what I would call cash flow hacking policy, which is designed for you to be able to have access, liquidity, use, and control of your money, to be able to invest in cash flow assets and have it as an emergency fund, have it as an opportunity fund, to be able to position yourself to take advantage of everything the world is going to provide for us for opportunities in the investment world, I should say, as we enter and then come out of this financial storm that we're coming into. So if you have any questions, any comments, comment in the comment section below. I will do my best to engage with every single one. If you haven't already, make sure you share this video, like it. It really helps the algorithm, and I think people in this business, in this industry, need to know this stuff. So anyway, thanks for being here. Till next time, have a blessed, inspirational day. We'll talk soon.